welcome back to Global Value. In today's video, we're going to be performing a fundamental stock analysis of Genco Shipping and Trading Limited, ticker symbol GNK. At the time of recording this video, Genco is trading for $18 per share. Year to date, the company's stock price has done well. They're up 13%, while the overall market is down quite a bit. However, going back the past year, their stock price is down 4%. We see recently, since about the beginning of June, the stock is on a downward trend. Going back 5 years, the stock has actually returned a pretty good 15% compounded annually. However, if we zoom out to 8 years ago when the business went public, Genco stock is down 91%. Genco is currently situated in the middle of its 52-week high and low. The business has about 3% of its shares outstanding sold short, and it is a $760 million market cap. For some background about the business, Genco Shipping and Trading Limited is an international shipping company specializing in the transportation of iron ore, coal, grain, and other core commodities. It's involved in the ocean transportation of dry bulk cargoes through the ownership and operation of dry bulk carrier vessels. It generates revenues through time charter agreements, spot market voyage charters, pool agreements, and spot market related time charters. As of December of last year, the business had 44 dry bulk carriers, including 17 Capesize, 15 Ultramax, and 12 Supramax, with an aggregate capacity of approximately 4.6 billion deadweight tons. Genco Shipping and Trading was incorporated in 2004 and is headquartered in New York, New York. We'll be performing a modified version of the 8-pillar analysis popularized by Everything Money, taking a look at 8 key financial metrics of the business to come to a holistic and beginning understanding of the business based on its financials. So let's get into it. Starting off with pillar number 1, we want their average 5-year PE to be below 22.5. Genco's earnings have been all over the place throughout this time period, so this pillar is going to have less of a significance overall than it usually would. Currently, they're trading at 3.5 times earnings, and on average, they've actually traded at negative earnings over this time period. So they do have positive earnings now, so that's going to be a check for pillar number 1. Pillar number 2, we want their average 5-year return on capital to be above 9%. So this chart is a great illustration of the current extreme boom in the shipping market. It's a highly cyclical industry. And looking at Genco's return on capital, it wasn't until last year that they were really able to earn above average returns on capital, with the rest of this being pretty terrible overall. Averaged out, they earned 4% return on capital, so that's going to be an X on pillar number 2. Also to note, over the last 12 months, they've averaged 20% returns on capital. So it looks like for the time being, at least from 2021 until now, this high watermark in the shipping industry is still there. In a highly cyclical transportation business like this, which is prone to those big booms and busts, you're really going to want to understand, are these good times going to continue for the industry, and some of the other supply and demand factors for the industry overall. Pillar number 3, we're looking for 5-year revenue growth. Genco has grown revenues more than double from $209 million in 2017 to about $547 million in 2021. So that's going to be our first check on pillar number 3. Pillar number 4, we're looking for 5-year net income growth. This chart again is reference to the current boom in shipping. Leading up to 2021, they had 4 years of negative net income, and that turned around to be positive in 2021. So pillar number 4 is also going to be a check. Pillar number 5, we want to see decreasing shares outstanding. When you purchase a share of stock in a business, what you're buying is a fractional ownership percentage in that underlying business. When a business issues new shares and dilutes existing shareholders, they're decreasing your ownership percentage of the business and ultimately meaning that you're going to be entitled to a lower percentage of the business's profits. Genco has diluted shareholders by issuing about 8 million new shares over this time period. That's about a 24% dilution. It's not as bad as some other shipping companies, but it's by no means good. And keep in mind that they had negative net income in 4 out of these 5 years, so they were not generating earnings while they were issuing new shares. That's never a great sign to see for a business. That's going to be an X on pillar number 5. Pillar number 6, we're looking for 5-year free cash flow growth. Free cash flow is cash from operations minus capital expenditures. It's this column in green. Free cash flow can be used to pay dividends, buy back shares, pay down debt, make acquisitions, or reinvest back into the business. It's the lifeblood of any company, and it's ultimately what a business is going to be valued based on. So Genco has more than 5x their free cash flows over this time period, from about $24 million of free cash flow in 2017 to about $114 million in 2021. So that's going to be a check on pillar number 6. Over this time period, while their net income only became positive last year, they've actually produced positive free cash flows in 4 out of these 5 years, only taking a real big hit in 2018 when they made a lot of capital expenditures. Even though 4 out of 5 of these years are generating positive free cash flows, in an average year over this time period, they're burning about $3 million of free cash flow a year. We'll use that number in pillar 7 and 8 coming up. Pillar number 7, we're evaluating how the business utilizes leverage. We want Genco's net debt, which is their long and short-term liabilities minus cash and short-term cash equivalents, to be below their average 5-year free cash flow multiplied by 5. At the end of last year, they had about $132 million of debt after subtracting their cash. Again, their average 5-year free cash flow was negative, so pillar number 7 is going to be an X. However, it is worth noting that over the last 12 months, Genco has produced $107 million of free cash flow. It's looking more and more like any investment into this business is going to be a bet on whether this boom in shipping continues or not. That's something that's ultimately going to require further due diligence and a better understanding of the shipping industry. So if that was the case, then they'd be able to pay off this debt. If not, and it's based on their historical averages, then they're not able to. Finally, the big pillar of them all, pillar number 8, we want Genco's market cap to be below their average 5-year free cash flow multiplied by 20. So currently they have a market cap of $762 million. Again, their average 5-year free cash flow is negative, so this pillar is also going to be an X. But if we're using that trailing 12-month number, then this business is only trading at about 7.5 times free cash flow. It's not dirt cheap. A potential investment in Genco is really going to depend on the overall cycle of the historically highly cyclical global shipping market. Lastly, I want to look at Genco's dividend profile. Investors make mistakes all the time by blindly chasing dividend yield. Instead, we want to make sure that a business's dividend is healthy and supported by its free cash flows. Genco started paying out dividends in 2019, and since then their dividend has increased quite a bit. Last year, they paid out 97 cents per share in dividends. Over the past 2 years, Genco has been more than able to support their dividends based on their free cash flows. And actually, over the last 12 months, they've nearly doubled their dividend. Over the last 12 months, they paid out $1.71 per share in dividends, and they've earned about $2.70 per share of free cash flow. So similar to other shipping businesses, Genco is using a lot of their free cash flow that they're generating right now. They're not reinvesting it back into the business. They're paying it out as dividends to shareholders. So that is at least a bright spot to see in terms of capital allocation. If these good times are to continue, it looks like the business is going to continue paying out large percentages of its free cash flows as dividends. In summary, Genco checks the box on 2 out of 8 pillars. They operate in a highly cyclical industry. They've had a huge increase recently in free cash flow. They're paying out a good portion of that free cash flow in dividends, and they're using the rest to get above average returns on capital over the past 12 months. This type of analysis is a holistic starting point. It's not a financial recommendation to go out and buy the business or to sell it short or to chase its potential dividend yield. So while Genco is paying out over a 9% dividend yield, we've seen that their business is cyclical, it's a commoditized business, and it's not sustainable in these down times. Any sort of further due diligence or investment into this business is going to be based on a deeper understanding of the overall global shipping market. That's it for today's fundamental stock analysis of Genco Shipping and Trading, ticker symbol GNK. If you enjoyed the video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Genco Shipping with me, and have a great day.